slides up there in a little bit. Why not put a couple slides in here? No.
Okay.
Hey guys, it's great to be here. Thanks for the invitation. So if you don't know me, I do advising for about 3 or 4 different companies. One of them just got bought this past week. I also do a lot of research for a couple different organizations, including SKBI in Singapore and R3 with Raja, which is based in New York. So today, I hope I'm not going to hurt too many of your feelings. I'm going to make the case for distributed ledgers and not necessarily a permissionless chain. By the way, this graphic here, it's from Santander. They just published a report about a week or so ago talking about what cost savings a distributed ledger could do. If I speak too fast, let me know. If you have any questions at all during this time, please let me know too. And I don't mind if you disagree, it's totally fine. There's plenty of people on Reddit who hate me. So who's developing shared replicated ledgers and why? I use the term shared replicated ledgers. This is a term came from Richard Brown. He's at IBM. And this is because people in the space who've been here for 3, 4, 5 years, they like to have their own trademark on the term blockchain, and they really hate people like me using the term blockchain when it's not based on Bitcoin. So I use the term shared replicated ledger because that kind of gets to the heart of the matter. Brief outline. So I'm going to talk a little bit about these different things. I think this presentation will be online this afternoon, so feel free to use it, take pictures, whatever. I'll have citations also in the notes. We're going to talk about the motivations for building a non-proof of work based blockchain. We're going to talk about especially unclear governance is probably one of the number one reasons. A little bit about where VC funding has gone and opportunities for firms like PwC. So you guys may have seen these on Twitter. These are derivative works. This is not actually what Scott Adams did. Scott Adams did not make Bitcoin related slides, but they're pretty funny. Especially if you worked in a corporate environment. You have the pointy hair boss explain how Bitcoin works, and he's like, don't give me the condescending version for managers. I want the full technical explanation. And Dilbert says, in previous civilizations they had no concept of zero. So if you've ever spent any time on Reddit or Bitcoin talk, people love talking about prehistory and gold and stuff like that. I'm not going to talk about gold today. The second one is, you see pointy-haired bosses, I think we should build a blockchain. And Dilbert's like, uh-oh, did you just read this about in a trade magazine? And then Dilbert says, what color do you want that blockchain? So the joke, this is actually, the original quotes were SQL database. So this was 20 years ago when that was all the rage. So I did not make those, just FYI. So questions for this session. What are the design assumptions when we're talking about this tech? Most importantly, what are the client business requirements? We see this a lot on Reddit and in conferences, people saying everybody needs a blockchain and it needs the Bitcoin blockchain for sure. Maybe at the end of the day, that's probably not true. Are entities and actors on the network known or unknown, trusted or untrusted? Who's allowed to validate transactions? So the term that I'll probably be using, I guess, or you might see this more in academia, this is, Ben Laurie came up with the term mintets. I think Ben Laurie's still over at Google. The idea is these are known validators on a network. Are they spread around globally? Do you need synchronous or asynchronous communication? How are fault tolerance handled? And do you actually need consensus? If Dave Hudson was here, I don't want to put words in his mouth, but Dave Hudson would probably say we probably don't need consensus for most of this stuff.
Who's Dave Hudson?
Dave Hudson, he's the VP of software development at Pure Nova down in San Jose. Why distributed ledger? So there's many reasons for why companies are looking into the space but are disinterested in Bitcoin, big B or little b. Primarily because of this. What do financial institutions want? They want cryptographically verifiable settlement systems that are compliant with various reporting requirements. Things they don't need, though, are censorship-resistant services or anti-Sybil mechanisms because they work on a trusted network. So that's kind of redundant. What comprises a permission blockchain? So I wrote a report, published it a couple months ago, and it used these diagrams. The intellectual heavy lifting primarily came from Robert Sams. He's out in London. He has a company called Clearmatics. Disclosure I'm an advisor for. And these are the 3 parts he calls a permission blockchain. You have a legally accountable validator, settlement finality, and suitable for off-chain assets. The legally accountable validator, I hear this often, we'll talk about it here. People are like, how do you protect the ledger without mining? Well, one way to do it is how we do things today, and that's make people have contracts, and if they don't fulfill those contracts, you sue them. So that's one way to actually hold people accountable, especially the validators. Settlement finality if you've ever done anything with an RTGS, so like with Fedwire or Chaps or Target2, or I guess Target2 is a settlement system too. You can't have any reversibility with that whatsoever. If you participate in the network, you have to sign a contract saying, such and such, and you technically cannot. You have to send another transaction to actually get rid of the previous transaction. Suitable for off-chain assets. And this is the big crux when talking about, and we'll talk about this with our little panel later on, with title transfer. So with the Bitcoin system, most of that's actually technically trading. When you say, oh, I'm going to put some asset on the blockchain, you're actually trading. You're not actually, there's no post-trade taking place because that actual title still has to be transferred somewhere else off-chain. And the idea with a permission blockchain is you could actually try to do both at the same time. You can't do that with the Bitcoin blockchain as it is. So what are the characteristics of a distributed ledger? So we talked about, this is permission blockchain. So here's a permission blockchain up here.
You have a pointer, by the way, on the top lines are red.
Oh my gosh. Don't tell the FAA guys, I got a laser pointer here. So that's just one aspect. Distributed virtual machine, that's obviously something that Ethereum's been pushing, the DVM. It's probably the trickiest part of their whole ecosystem. By the way, Ethereum is not considered a distributed ledger in my book because it's not permission based. Smart contracts govern off-chain assets. So a lot of talk. This is probably the only thing I'm going to mention about smart contracts all day. This is not to talk about bananas. So, or I guess if you weren't here for a few months ago, we called them bananas. Network achieves settlement finality. I think this is the most important part, and one part that a lot of Bitcoiners miss out on is because they don't have a background in financial services and how post-trade settlement works. Unless you actually have title that transfers, then it's actually not actual settlement. So we don't have that with the Bitcoin blockchain aside from the Bitcoin currency itself. Any questions? So this is for those consultants in here, you might like this. This is from Richard Brown's. This is from a post he made a couple weeks ago, a month ago. And this is a term he's been using. So again, he calls it an industry level systems of record. So I've been in meetings where people call a blockchain enterprise grade level blockchain, a bank grade level blockchain. So this is his term, and his assumptions are you have a private network, you have known actors, and these actors vote with the various consensus methods. There's not a single one saying, oh, you need to have 1 out of 3, or 2 out of 3, or 3 out of 5, or whatever it might be. And he calls it a shared system of record. So here's a bunch of buzzwords right here. He says you have a global transaction processing system, inter-firm unified system of record enabling new platforms for financial innovation based on a common ledger API. Well, that'd be great. And that's if you talk to a lot of the VCs in the Bitcoin space, they're like, yeah, yes, Bitcoin is that. And I'll make the case of why Bitcoin's not that. But that's not to say that Bitcoin can't be used for other things. Any questions about this slide? A lot of buzzwords. Again, this will be all online. So this is something you might be interested in since you guys are all developers here. Actually, raise your hand. Who's an actual developer, software developer? And who actually does BD or business side of things? Any? Okay, cool. And who here actually works at PwC? Wow, it's 2 of you. Okay, well, that's fine. Again, I'm not going to sit here and argue about if it's better to call it a distributed ledger or blockchain. But these are companies, these are startups, all about just about a year old, maybe a little bit less, that are been formed. Blockstack is here. Ledger, they're actually renamed themselves. They were Tillit in the report. Miles Cohen's in New York, and they've been looking at like syndicated loans is their use case. Clearmatics, they're in London. They're primarily looking at OTC derivatives settlement and clearing. Hyperledger, again, disclosure I was an advisor for. They just got acquired this past week by BAH. Eris, this is Preston Byrne. I believe here at Blockchain University you've had Ethan come talk to you guys before. Yes?
Yes.
Is
So
it this cohort?
not this cohort, unfortunately.
Previous cohort, okay. So they're spread around globally though. Tezos, based in New York and France. Good guy. I could try to introduce you to him if you'd like. Tembusu, they're based in Singapore. They forked Ripple about a year ago. Integrated group signatures. DAH, you may have seen them in the news, Digital Asset Holdings, New York City, Blythe Masters Company. They just acquired a couple different companies too. Guardtime, they're based in Europe. They're working on the e-Estonia project. Their primary use case is they're trying to secure, or they call it data security with the blockchain. And I haven't seen the guts, so I don't know if that's true. PureNova, they raised about $19 million end of last year, beginning of this year. They pivoted out of Bitcoin. They used to do mining, and now they're just doing, I like to, don't tweet it, but they're pretty much like the non-religious version of Blockstream. If you've met Blockstream. They're really nice guys, but very fervent believers in Bitcoin, but PureNova's not. SKU Chain, is Zucky here? No, I don't see him. Sri? No. So if you haven't had a chance, next time you guys are in Mountain View, you guys are literally in the location where SKU Chain is. They're doing a couple different products. One of them is Providence on using a blockchain. I talked to Zucky. He still calls it, a proof of work system. That's why I put an asterisk by, because technically speaking, you don't need proof of work if you're using a permission system, but it is a permission system. He's just doing it because, I guess, technical limitations with the team, or just they don't have the resources. I don't know. Purchase Chain. It's a pretty cool product. If you've ever gone out to Singapore, there's a number of people you could talk to about trade finance, letters of credit, bill of lading. If you took somebody from the 19th century, nothing much has changed in the process of how apparently the trade finance system works. So a number of banks out there are looking at ways you could actually apply some of this technology, including bananas or smart contracts or whatever you want to call them. I don't like the term smart contracts because it's not really well defined. Multi-chain. So this is Gideon Greenspan's company out in Israel. Actually, Coin Science is the name of it. They have an interesting white paper that you can check out. This came out this month. And basically, they fork Bitcoin. They're actually, I'll be honest, I think they're a little similar to you guys, Peter, at Blockstack. Ripple and Stellar, I put an asterisk next to these guys too because in theory, they're permissionless, but in practice, they're permissioned. So the way Ripple works, does anyone here work at Ripple? Kind of? All right. In theory, anyone could run a Ripple V node, and you can. Anyone can run a Ripple V node. You can get the transaction history, but you're whitelisted and blacklisted into who actually processes the ones that Ripple actually recognizes effectively. Maybe that will change in the future. I don't know. Stellar, they were down to just one node for the last 8 months because they broke consensus somehow, and now they have this SCP. So I guess they could, depending on how you fork it and how you run it, you could do permissioned. But in theory, they're always, I know Joyce is out there always saying it's permissionless and stuff like that, but it's not, at least in practice. Then you have traditional tech companies as well. IBM is looking at it. I know of at least one other financial company that does hardware or software for fintech, but I can't announce them right now. Any questions about these startups? Yes.
PureNova?
Oh, you're talking about the banks in Singapore, right?
Yeah.
Can you name Depot and DBS?
No?
Okay.
Anybody else?
Tim, PureNova. Not a whole lot out in the public domain.
Sure, you might not, in fact, I get asked this a lot. Why don't we hear more about what they're actually working on? Well, number one, the banks that they're working with don't want them to know. Don't want them to know. And number two, you may never ever hear actually what they're working on. I had lunch with Dave Hudson this last week. If you haven't met him, Dave's the nicest guy. You should definitely talk to him, regardless of what your opinions are. And he's like, there's just really no advantage for us to actually, do the PR machine thing. So I don't know if we'll ever know.
I would say the same for folks like us at PwC. But yeah, it's an interesting company. Just curious.
Sure. Any other questions? So they're all targeting different use cases. If you go to any conference, people mention a bunch of different things. Here are the ones that come up in conversations I've had with these people. Syndicated loans, that's something that again Tillit, or called Ledger now, and DH have talked about. Trade finance, I believe Timbusu's talked about it. Obviously, SKU Chain's talked about it. It's kind of hard because you have a fragmented market just globally. There's no such thing as a one unified trade finance system. It's very decentralized, as you might say. Supply chain provenance. A couple different companies that have looked at that, including I believe PureNova actually looked at it. They think it's a real market, but again, it's one of those tough fragmented markets too. U.S. Treasury repo. Maybe Raja can talk about that a little bit later. Clearing and settling OTC derivatives and FX. That's everybody. Literally, that's the low-hanging fruit everyone's trying to do apparently. Cross-border payments. This is more to B2B than remittance, although there are people talking about remittances too. Identity and data authentication. So that'd be I guess, guard time is kind of doing that. Identity would be more like Timbusu. To be honest, it's pretty difficult. I know people are always saying, well, we're going to put identity on the blockchain. It's a lot harder than you would expect, especially if it's a permission-based system, or even permissionless system. Equity issuance and private stock. People have been doing or claiming to have done this for like the last 3 years with different types of meta coins. But again, you don't have actual title transfer unless you actually have post trade taking place on the chain, and there's no one's done that yet. So commonality. Participants in these networks are basically known. They have KYC or KYB. If you're not familiar with those terms, KYC is know your customer, KYB is know your business, and have legal or contractual obligations with other participants. Yes?
Tim, have you heard anybody talk about internal, external recon trade breaks as a specific use case?
Wow, that's interesting. I have not been part of the conversation with that. Raja, have you?
I'm sorry, what's the question?
Internal, external recon, trade breaks, that sort of thing on the front end?
I mean, that's part of the whole trade life cycle. That's just one component of it. So, reconciliations of trade books is a big, part of the process. So just tackling it on its own is not enough. There's plenty of companies that actually do that. The hard part is the time management around reconciliations at the end of the day. And then reconciling books across jurisdictions, so you've got multiple books across London, Tokyo, New York. So reconciliations also has to do with the asset class itself, because each has its own trading characteristics. So from that perspective, internal, you know what I mean? That's too small a definition. It has to be a much broader concept.
It's a good point you brought up, though. If you guys have ever talked to CLS, do you guys know what CLS is? I don't want to go through the whole explanation. Basically, they provide, with like the 19 central banks, they work with settlement for clearing FX, basically, in any given day. And the interesting thing about how their system works is, in order to be a member on the network, or to participate in the network in a country, you have to have like extraterritoriality built into the contract, saying, irrespective of what takes place within this jurisdiction, you're going to abide by a certain code. And that's one of the interesting things you're going to have to do with any of these permission or permissionless systems, is figure out how do you contractually get jurisdictions to, or companies with or traders within a jurisdiction to be compliant or harmonized with other jurisdictions. So that's a whole other conversation we don't have time for. So what attracts or repels use cases? So yes, go ahead.
So it's a good question on that side. With so many players playing for the OTC space, what are they all vying for? What hasn't been yet solved, or why are there so many? Sorry, that's a very
Actually, that'd be a great question we could talk about during the Q&A. So that's a wonderful question. So there's a folk law. Anything that needs censorship resistance will gravitate towards censorship resistant systems. So remember, Satoshi's goal was to build a censorship resistant digital cash above all else. I don't know who he is, but even if you took away the ideology, I'm not sure if he would have built a permission chain, just because if you wanted to, you can't build censorship resistant cash with a permission chain because it can be censored. Sam's law, this is Robert Sam's law, anything that doesn't need censorship resistance will gravitate towards non-censorship resistant systems. So that seems like a truism. So banks are currently focused on fulfilling compliance requirements, reducing cost centers, downscaling, branching, implementing digital channels. None of this requires censorship resistance. So again, I'm not saying that I can speak for all banks or even any banks, but when I'm in those conversations, they're not looking for the ability to not be censored, because they have to do KYC and follow different regulations. Any questions about that? Okay. What is one opportunity for professional service firms like PwC? Finding ways to reduce cost centers. So Deutsche Bank had a study about 3 years ago, December 2012. They found that the percentage of revenue is 7.3%. Banking and IT costs represent about 7.3% of their whole cost structure versus 3.7% in the regular economy. Solent had a report earlier this year that said that basically by the end of this year, about $200 billion will be spent on IT spending for banks in North America, Europe, APAC. And then Santander, this published report, that said by 2022, banks will be saving about $20 billion a year, give or take, on IT costs using distributed ledgers. Again, estimates, some things to take into consideration for PwC. For accountants, so I asked Pinar, if you're not familiar with Pinar Madar, she's used to work with the London Stock Exchange, Citi. Now she's an advisor with Raja and I for this group in New York. She was also an advisor with me at Hyperledger. Basically, if these systems actually take place, you need to learn how to audit them. If they can't audit, nothing can happen, so they should be prepared. This is the TLDR on that. So makes sense if you're trying to work with systems and these systems get integrated, you need to know how to use them. So what about proof of work based permission systems? So go to CoinGecko, pretty simple site. If you're looking at CoinGecko.com, they rank things primarily proof of stake and proof of work coins. I don't think they do anything besides those two types of coins right now. And what they do is they try to put this metric on in terms of like developer. You see this developer number here. This is based on GitHub, like how active is a GitHub repo, commits, access, that kind of stuff.
What's the site again?
CoinGecko.com. Community, this is based on Reddit and Facebook and Twitter, like how active is that. Public interest is based on Bing and Alexa. Obviously, these metrics are difficult to necessarily, put together a weighted average score, and it's also difficult to know who's gaming it. As we've seen with like Reddit on any given day with Reddit Bitcoin, you have like 170,000 subscribers, but only like 700 people go. It's pretty clear that there's a lot of sock puppets on there, or people who just created accounts just to inflate that number. With Litecoin, a funny experiment would be if you had a major forking incident, people would be adding stuff to the repo continually, like lots of commits and lots of pull requests and stuff like that to fix whatever's happening. So on this metric would actually look good, even though Litecoin's crashed or something like that. So you have to take, it's kind of hard to put together a good quantitative number, but CoinGecko, they're out in Singapore. I can introduce you if you'd like. So here's 10 different coins. I'm not going to go into the different coins and what they do. Any questions, by the way? I just have this slide just to show that I am aware that distributed databases work and exist. I get this a lot. People are like, Tim, why are you building a permission ledger system? It's just a database. It's not. If it's a database, show me a database that can do what a permission ledger system can do. It doesn't exist yet. But maybe at the end of the day, in 5 years from now, all the big companies like IBM and Oracle and so forth just buy all these other startups up, right? That could happen, and maybe you technically work for a distributed ledger or distributed database company. The two I'm going to point out, Hyperdex, based out of Cornell, Eamon Goodensayer, he's the one who did the, he's an academic out there, and he's actually the one who did the selfish mining report, if you guys remember that paper from 2 years ago. IPFS, that's, if you're not familiar with Juan Bennett, he's an instructor at Blockchain University. It's a really cool system. I guess we could talk about that in the Q&A if you guys want. I believe you're familiar with most of these other database systems. They're different, guys. It's not the same thing as a ledger. So blockchain does not mean Bitcoin. See this a lot. I was just reading a Wall Street Journal article yesterday talking about, everyone wants to use the blockchain. And they never describe what blockchain. There's like 550 active blockchains out there, at least, from proof of work systems. So when you say a blockchain, most people talk about the Bitcoin blockchain. But this is just my own view. I think that the people who usually just do that, they're just talking their own book. It's typically VCs who are heavily invested in Bitcoin. And I understand, they want those investments to do good, but it's not really fair to equate blockchain solely with Bitcoin. So in fact, I'm not sure if Greg's going to be here. Is Greg coming today?
Yes.
Okay, so Greg's Seplock, he's one of your guys' instructors. He actually got into a little tiff with Chris Dixon over at Andreessen Horowitz about a week or so ago. He said, Nakamoto saw consensus is just one way to come up with consensus. It's not the only way. And so he actually got blocked. Chris didn't like that statement. Over 30 years of academic research has been done. In fact, Christopher Allen's here. If you talk to him, he's just living history. I say that in a good way. Talking about, look, we've had consensus in distributed computing, that idea for 10, 20 years now. There's a whole academic prize called the Dijkstra Prize that's awarded annually on that. Technology is iterative, and Bitcoin may just be just a proof of concept, and I'm not saying that in a bad way. We've learned a lot of things, and we will continue to. Again, the reason I say that is because of its primary focus on being censorship resistant.
So 1988, Ecology of Computation has a whole lot of this stuff. Consensus, Byzantine protocols, the whole bit from 1988. Well, this is pre-internet. You can't find this book because it was basically printed before people started making these books available on the internet. But it's there. People
I don't know. We need to see the hash of that. The public hash. Is that on the blockchain to make sure that hasn't been modified?
Yeah.
What's that book again?
It's called The Ecology of Computation. It was a collection of papers, 1988, and this is my patent busting book because a lot of things that people have tried to patent in the last 15 years are mentioned in here.
So a lot of prior art. Huh?
Yes.
So I had a kind of a popular post a couple weeks ago. Needing a token is a red herring, probably. Again, the reason you have a token in Bitcoin itself is because you need to incentivize miners to destroy capital somehow. You have to prove that you're actually doing some computational resources that cost real money in the real world. But if you're using a private network, you might not have to do that, and I'll explain why. Again, I'll step back actually. There's other ways of securely validating. We can have a whole presentation on how you securely validate stuff, rather than just destroying coal in China or using a consumer device-based Tom Sawyer botnet. That's my way of talking about 21 Incorporated, basically installing a bunch of devices and stealing electricity. In general, why don't permission shared replicated ledgers necessarily need a token? Again, if you have a real-world identity and you have a contract with a company to do validation, and you don't do that validation, or you do it poorly or whatever, you get sued. So there's plenty of incentive not to be sued. To do that. And again, you have different compensation model with public networks. The marginal costs are different. Does anyone know what the marginal costs of the Bitcoin network are? It's pretty simple. You just multiply the token value times how many tokens are being created at any time. So at any given day, about $800,000 is generator. That's how much it costs to run the network. And I know people say, oh, that's not true. But miners aren't going to destroy capital unless they get the block rewards. So that's how you measure it. And you multiply that by the whole year. So about $200–300 million this year based on the current price. So that's a different marginal cost, and it was intended to be that way. Otherwise, it's really cheap to attack. You see this a lot, VCs, and I don't want to call out Jeremy Allaire, but he said this at one point, like 5 months ago. He's like, at some point, it'll be cheaper to run the network. If it ever becomes cheaper to run the network, it also means cheaper to attack the network successfully. So there's this yin and yang in terms of how much it costs and how much it doesn't to attack. Any questions about that? So why don't we just use one chain for everything? I see this a lot, this one-size-fits-all approach. Look, you have some needs for an A380 bus for your organization if you're going overseas or something like that, and then sometimes you just need a Cessna. So each of these airplanes have different utility. One size doesn't meet everybody's needs. And this also, we're going to talk about the blockchain size in a moment, about how this can impact you and why you might not want to use a public network. Ethereum's testnet's already 30 gig. And it's just been testnetting for 2.5 months. Obviously that will change. Maybe it'll be less when they actually go because they're trying to purposely flood it with transactions. Bitcoin's mainnet is at 36 right now. Again, and I'm going to talk about this. Probably the most important part about putting an actual security on a public blockchain is you end up having basically top-heavy issues, and you don't necessarily need to build a marginal line, or you don't need to brute force that with hash rate. So if you guys studied history at all, in the 1930s, France built this wall on their eastern border with Germany called the Maginot Line. Did the Germans go through it, guys? No, they went around it, right? And that's the same thing. We have fan fiction here in Bitcoin land where people think, oh, you need to, in order to attack the network, you have to build hash rate to go attack it. There's plenty of ways to go around that now that you have increased block maker centralization. We can talk about that in a little bit. But generally speaking, one size fits all probably is not a good thing. I don't want to make, I'm not trying to belittle BitGo. I think they're actually an honest player in this space, but this is just an example of one of the problems with out of terms of service. What happens if you have a problem with your transaction? What do you do in Bitcoin? You go on Reddit, and you go on Twitter, and you post a lot, right? And you hope somebody upvotes you or retweets you or something like that. So in the event of a block reversal or censored transaction, there's no terms of service. And you don't even have to worry about those things. What if you make a mistake? Remember, these are bearer instruments, these are bearer assets, so it's very caveat emptor-ish. So just 2 months ago, a BitGo user, because there was a glitch in the software, accidentally sent a miner 85 Bitcoins, which was, I guess, how much money was that at that time? It was about $300. About 20,000 bucks or something like that. Am I doing the math right on that? Yeah. So but what ended up happening is they actually sent it to a pool. Since these pools identify themselves, they sent it to Ant Pool, and Ant Pool ended up, sending it back as trying to be a good member of society. But it actually defeats the whole purpose of proof of work blockchain. Like if you're able to identify who's actually you sent it to, and that person sends it back, why do you use a permissionless system? So in the future, who do you call? Like if we have a problem, when Visa has problems, do they just spend all day on Reddit or on Twitter? No, like building a financial product and expecting to use social media to do customer support, I think is very unprofessional. And that's not to belittle these guys. These guys are very professional. I think BitGo's a good actor. Is anyone here from BitGo?
Just backing up though, I mean, I don't know, not to get into a debate or whatever, but I mean, why do you say it defeats the purpose of a proof of work blockchain? I mean, it's no different than, I mean, if I'm carrying around a bag with, $100 bills and I leave it on the subway, I mean, it might just so happen that somebody picked it up who's really nice and I'm able to track it down and I get it back. I mean, that's really essentially what happens.
Can you repeat the question?
So yeah, his question is if you have a bag of cash and you leave it somewhere accidentally and somebody's nice and gives it back to you, that's altruism. The whole system though was built on the principle that you don't have to rely on altruism. So like the whole game theory around it is the incentives are aligned to where you're going to behave a certain way no matter what. Obviously that's not the case. They did it just because they wanted to have good PR, but in the future does that mean that they're going to, like when you have a block reward halving and you're only getting 50% of the same income, 85 bitcoins and fees, hey, maybe I'm not going to be nice this time around. So I don't think it's necessarily a good business practice. I don't think Antpool should have done that. That's just my opinion. And I actually sent them a message. I know the guys from Antpool. I was like, dude, don't send it. And they're like, why? Well, we want to look good. And I was like, no, don't do it. You're gonna have to, what happens again if they do that? Then they'll feel obligated that they have to do it right. So unintended consequences. Interestingly enough, when you go to charts and you see what pools have amount of hash rate, that wasn't always the case. In fact, up until the late 2010, we had no idea like who was really mining. And then Slush, they began mining or pooled mining in November 2010, and they were also the very first entity that publicly claimed to mine a certain block. And since then, we've had different pools to mine or to declare it too. It kind of defeats the purpose of using an untrusted network. If you don't trust people and you don't know who those people are, and then you start knowing who these are and start trusting them, you're actually turning it into a permission system, but with the same cost structure for permissionless. So again, I'm not saying these guys are bad. They're doing it because they want to have PR and stuff like that.
There's also that website that got announced last week that basically did a statistical analysis of all the blockchain, all the connections.
Elliptic did that.
Elliptic, that's it. And then they also did looked at all the change addresses.
They were looking for money laundering. That's what they were trying to
And
do.
basically were able to find all kinds of interesting relationships between the different things. So it was.
Yeah, sure. If you guys are trying to use Bitcoin to money launder, watch out. We'll talk about that a little bit later too. So there's some trade-offs with this diagram here. So this is Robert Sam's mental model of what I guess in databases you have CAP theorem and FLC and stuff like that. This would be for distributed ledgers or blockchains in general. So you have forgery transactions. This is actually pretty easy to fix on both permissioned and permissionless. You just use cryptography. We already have public key and private keys, so we have an idea who signs signatures, signs transactions. Sins of omission and sins of deletion. These are the two where the two systems are different. And I'm not saying one's better than the other, but they have priorities. So with a permission system, reversal of transactions is paramount. You can't be on one of these RTGS networks and reverse a transaction. Whereas with a Bitcoin-like system or permissionless system, censorship resistance is the goal. That's what Section 1 is all about. It's not having to do with trusted parties. So here's a little bit about that. And so my argument, and Robert's argument and other people's, is existing legal systems will likely never recognize a system of property titles that can be reversed by anonymous or pseudonymous validators. So last July, EBA, it's the European Banking Administration or Association, or whatever, they came up with a list of their concerns and like, well, hey, if we have a validator that decides to reverse, a financial contract on the system, well, what do we do? This seems like a concern to us. Do we call them? And if you could call them, then you don't need to have pseudonymity anymore. You might as well use a permission system. So Robert Sams, in his view, says the crux of the issue is permissionless consensus systems cannot guarantee irreversibility, cannot even quantify the probability of a history reversing attack. He's not saying that to hate it. But Robert doesn't hate Bitcoin. I don't hate Bitcoin. It's just, again, we're trying to solve a different need, and that need is irreversibility of financial contracts in a Wall Street or / London situation. And so you don't need proof of work or anonymous validators for that situation. Any questions about that? It's okay to disagree, by the way.
Question, coming back to the permission ledger and proof of work.
Mm-hmm.
So in the permission ledger, you still won't have Are you saying that there's no need for proof of work or?
The purpose of proof of work is it's an anti-civil mechanism, anti-spam mechanism to prevent anyone from changing transactions
Right.
because you don't know who they are and you don't trust them. But in a permission network, you already have done whitelisting of validators. Anybody else? Sunk costs. So not to pick on Brian, but he made this tweet 3 months ago, 4 months ago. He said, Ripple, Stellar, and altcoins are all a distraction. Bitcoin's too far ahead. We should be focused on Bitcoin sidechains. Okay, this is just a sunk cost argument. This would be akin to saying Reddit, Slashdot, and 4chan are all distractions. GeoCities is too far ahead, and we should be focused on GeoCities. Does anyone remember GeoCities? All right. Just because it was the first and had a lot of traction early on doesn't mean it was the one that won. And so, like, empirically, we know this is not true because if there was already a network effect, I hate using that word because it's overused in the Bitcoin space, but if there's already that kind of gravitation, there would be no capital for companies like Hyperledger or any of these other startups. Everyone would already be focused on that. It's like, why don't I compete with Facebook now? Nobody's going to give me capital to do that. So yeah, it's a sunk cost argument. I don't think it's going to work out in the long run because they're solving two different things. Maybe Bitcoin becomes the ultimate cryptocurrency, but not permissioned.
I think there's two separate points. I agree with you completely on the sunk cost point. But I mean, there is and maybe this is what Brian was really saying, maybe not. But I mean, there is a legitimate, positive network externality argument that can be made. And I agree. I mean, you're saying, well, the fact that there's funding going to, some potential competitors, says that, maybe.
So to get that, like,
yeah, but
he
but I
needs.
mean, beta. We're all, well, to the extent we still have BCI, we're all watching VHS, not beta, even though beta was,
Sure. Yeah. We nobody can. I don't think is anyone here clairvoyant? I don't think anyone is clairvoyant. You're not clairvoyant either. Again, I don't want to pick on Brian, but I think he just needs to publish the metrics of actually what are the ways we can tell that something's actually happened. I would disagree that there have been substantial network effects, but that's just my own view. Watermark token creators make public networks less secure. So this is not to be mean to these guys. They create utility. All right, it's really cool projects. Anyone here work for Counterparty or no? Okay. So if you're not familiar with Counterparty, go to counterparty.io. Omni's renamed for Mastercoin. Doge Party is a fork of Counterparty, but on the Dogecoin network. Does anyone need an explanation of what these guys do? Okay. So basically what happened about in late January last year, about 2,200 Bitcoins were sent to a provably unspendable address, a terminator address on the Bitcoin blockchain, and something called XCP was created, a counterparty currency. So they used a proof of burn to create a coin that could only be natively used with their embedded consensus system. So a system on top of Bitcoin, or it so happened to be Bitcoin, it could be used on any of the other ledgers. The idea was, hey, you could actually use this network to do functions you couldn't do with Bitcoin as it is today, or then 2014. Doge Party is the same thing. You had about 2% of the money supply at Dogecoin burned in August last year. It was actually 2.2% or so. To do the same thing, people just issued these assets and they claimed that these represented certain things. In practice, it's just bucket shops. I mean, I'm not trying to be mean, but that's kind of, if you can't deliver the product, or you can't deliver the assets, then you're bucketing, I guess, by CFTC standards. I'm not the expert. You guys are the Wall Street traders. So, and again, this is not to pick on these companies, but these are guys who are trying to do it. Chain, NASDAQ, Gift. Anyone work for those guys? Oh, okay. So they've all made announcements that they're going to use something called open assets. It's an implementation from Coin Prism. Most of these setups, they require identification of all parties, and they also have a 2 of 2, 3 of 5, 2 of 3, kind of some multi-sig setup to where nobody can actually steal that asset. But the problem with this is you end up centralizing it, so you're actually not using the blockchain in a decentralized manner. And because all parties are known, there's really no value add in using proof of work still. I know that they're using Bitcoin because it exists and there's not a whole lot of other things to use, but that doesn't mean it's the best thing to use, and probably won't, I would argue probably is actually bad in the long run, and I'll explain why. It's also worth pointing out there's a difference between bearer assets and registered assets. So these virtual currencies we're used to playing around with Bitcoin, Litecoin, all that stuff, these are bearer assets that to control it, owning is controlling. You have that private key, that's the credential. It's reincorporating this idea from 500 years ago. Everyone's their own, bearer. Registered assets, what you typically talk about, like Apple equity and stuff like that. You have to have a registered asset. You have to basically KYC all the parties, the participants, who's using the ledger, and so forth. So it's a bit different. You're kind of cobbling these two together, and it's not a really elegant way of doing it.
I have a question.
Yeah.
The Open Assets Protocol is an open protocol, right? So the NASDAQ implementation on top of that protocol may require KYC, much like Coinbase may require KYC on top of the Bitcoin protocol. But I don't think it's fair to say that everything on open assets is going to require identification. And to me, that's the open protocol nature of open assets is what makes it interesting.
Could you summarize the comment? I'm sorry.
So yeah, he was saying that so there's multiple implementations of open assets because it's open. It's an open protocol. Anyone can modify it and use it as they want. And it's unfair to generalize saying everyone's going to have to be identified using it. He's absolutely right. The only ones that I'm aware of that are using it in this manner are NASDAQ Chain and Gift. And again, they haven't public. This is just in private conversations I've heard. I guess it's public now that it's being recorded. That they're going to have multi-sig, so that way control is held. One of the keys is held by the organizations. Actually, I don't know fully what Gift will be doing. They just announced that they're going to do it. I'm just saying, in general, the problem with this setup is the fact that you're actually there's no settlement actually taking place because you're still having to rely on outside post-trade finality, which defeats the whole purpose of having a blockchain in the first place. I mean, why don't you use a database?
Rewinding a little bit, you mentioned that around 2,200 bitcoins are sent to a terminator address where they're just
Permanently burned.
What's the purpose of doing that?
Could you repeat the question, please?
So he was asking about, so Counterparty last year, January, they about 2,214 bitcoins were sent to a permanently provable, unspendable address. What was the purpose for that? It's to show that, what was the actual quote that Adam said that, you can prove that no malfeasance is taking place. Like what happens with a lot of these crowd sales is you give these people bitcoins and now you have to trust them that they're not going to, spend those coins on other things or just steal it. These developers can't actually steal these coins because they have no access to it. Right. So it's just an exchange basically. They created XCP at a fixed rate relative to the Bitcoin being permanent.
I mean, fundamentally, at one level of abstraction higher, it's really no different than the way proof of work works, right? I mean,
you had to do proof of work. Yeah, proof of work to proof of burn.
Exactly.
You couldn't get the burn unless you did the work originally.
Right. But essentially, it's the same concept. It's the same way that miners are proving that they're consuming electricity and doing make work to verify that they're a trusted verifier and
yeah, I couldn't just make up a hash and send it, saying, hey, this is real. Any other questions about that? Like, we could probably do a whole presentation. It's just a really cool topic. But so in the setup, when you're looking at an attack vector, if you're trying to attack a NASDAQ asset on the Bitcoin blockchain, now you can't steal that, so you really can't do a double spend. But what you can do is you could reduce and undermine confidence. So Gemini is about to come online. I think it's a neat platform out of New York. No, I don't own any equity in them or anything like that. The reason I think it's neat is because it's going to be the first time we're going to have institutional level ability to short Bitcoin. Again, I don't have a trading position at all on any coin. I don't even own any coins or anything like that. But what you can do with this is that since there's no ability to actually short without having to have the counterparty risk of the exchange running off with your cash, Gemini is not going to. The Winklevoss brothers are not going to steal your money. I don't think. Again, don't hold me to that. All right. I'm looking as I look at the camera. Instead, you create undermining possibilities. So in China, just disclosure, I worked out in China for about 5 years and moved back here to the Valley about 18 months ago. In China, in the fall of 2013, and during the run-up of price, you had Chinese traders hack or pay people to hack into journalists' Weibo accounts. Weibo is like Twitter in China. And basically, they would upload false documents saying that the government's going to crack down or is going to approve or whatever they could to actually make the market spooked. And so what they would do is they would sell coins before that happened, and then as the market got spooked, they would buy coins again at the bottom with the belief that it would go up again. So that's kind of how what could end up happening once Gemini comes online. In fact, I probably could raise some money just trying to spook the market. So if you're a VC and you're looking for some interesting attack vectors, talk to me. Another thought experiment, and I got this from. Do you guys know who the Piachu is? He's in Canada. He's actually a Reddit moderator. He's actually very open-minded for being a Reddit moderator, put it that way. So this is actually his thought experiment. Basically, it's pretty easy to stifle any platform like Counterparty or open assets on the Bitcoin blockchain. Because what you could do is you could create a website that says, hey, I'm going to pay a block maker a certain amount of money to censor a transaction. And so, or censor Omni or whatever it might be. We've already had lots of debates. If you look at Luke Dash Jr., he's always arguing about, we don't want to have counterparty transactions or whatever. So, in fact, today, Iliagis, which was the pool he created, doesn't allow Satoshi Dice transactions to come through. So we already have a type of censorship, if you will, because we have an idea of who the originating address is. So you could do that pretty easily if you want to go after financial instruments that are worth a lot. Any questions about that? So long story short, Robert Sams came up with something similar. He had a post about a month ago, said no, the Bitcoin blockchain will not be what we use for settlement finality for financial products. And his argument is like, look, if you have to use multi-sig and you have to identify people, you've already defeated the whole purpose, the reason of proof of work in the first place. So you basically create the cost structure, you're recreating the cost structure of the centralized world without the benefits of decentralization. So it's kind of like the worst of both worlds. Obviously we could argue about that, but I think he makes a pretty good case on that. And this is the part where I'm going to say it actually makes it dangerous. I think permission ledgers are actually doing a favor to permissionless systems. I think we're actually helping them out. Because instead of destroying Bitcoin as it is by making it permission-based, by doing KYC and stuff like that, we could actually offload that. Now, that's just my pitch on permission. But and I'll explain that. So what ends up happening is, in the long run, miners are going to destroy enough energy to where 1 Bitcoin equals the value of a Bitcoin. So in economic terms, the marginal cost equals the marginal value. The way to think of this is if tomorrow U.S. Treasury said, okay guys, anyone can print money as much as they want, and what ends up happening in practice is in a private seigniorage system is you as an individual end up printing or basically bidding up the price of a dollar to where it equals the face value of the dollar. Whereas in our state seigniorage system, the marginal cost is less than the marginal value. So it doesn't cost a dollar to make your dollar. All right, does that make sense? So the way Bitcoin works is, and you see this in practice, is when the value of the Bitcoin goes up, more hash rate's dumped on, and it actually bids it up to where, for generally speaking, for us, it actually costs a dollar, or it costs a Bitcoin to make a Bitcoin. The only people who actually have that margin are people like Bitfury or some Chinese miners who could get scale, or 21E because they steal electricity or something like that. So none of us have the ability to I don't have the ability to steal electricity. So the problem with this is so in a given, miners are destroying an equal amount of energy that's rough about $3.5 billion to protect those assets. If you start putting on this equity from Apple or something like that, you end up creating a top-heavy system to where the miners are actually not destroying capital equivalent to that actual equity that's being valued there. And this has actually been known for a while. This is actually one of Blockstream's arguments against colored coins, or meta coins. There's many different things. Watermark coins is the best thing. Now, people say, oh, you could make a pool meta-aware, so they could tell miners, hey, this asset actually represents this value, you need to destroy this much capital to do that. But once you make a pool meta-aware, you open it up for vulnerabilities to censorship. So this is Peter Todd's argument, hey, guys, we have to make sure that there's no way pools can identify a transaction, otherwise it'll be open to censorship. So if you're working on any of these counterparty platforms or whatever, just be aware that you actually could be creating a dangerous situation in the long run.
Plus the whole, you're basically paying X millions of dollars a year for censorship resistance, and then you're basically not using it.
You're defeating you're not using that actual utility. He says you're spending like $300 million a year for censorship resistance, but then you're not using the censorship resistance itself because you're doxing yourself. So the reason these are popular though is because it's a quick way to add features to Bitcoin. And the reason why this is important is because the development cycle for Bitcoin itself is pretty slow. Why is that? Because you have nebulous governance. So, and I'm not trying to be mean, we know this is true. It's a public good, there's nobody who owns it, that's why it's called a public good. So there's no one to hire, fire, or make decisions on how this blockchain should evolve. And that was done intentionally. We know that was one of the features of it. But what ends up happening is this creates uncertainty for new features, because we're relying on altruism for people to actually build this. Instead, what ends up happening is, like ring signatures was first tried out with CryptoNote, group signatures with Sambusu. All the really interesting features take place on altcoins because they don't, if you don't like how the chain is working, you just spin up your own and try out that new feature. You can't do that with Bitcoin main right now. And so what ends up happening is, what we've seen is a lot of the main changes that we want to end up happening is it devolves into factionalism, and you see this right now with the block size debate. Well, we'll actually talk about that. And Sadly enough, is the debate surrounds who's the most popular on Reddit, and getting people to upvote your view on block sizes. And I don't think this is a really good way to build a mission critical financial product. That's just my own opinion. I don't see Visa out there like, hey, upvote whether or not we should slow down our system or do 70,000 transactions per second or something like that. That's not something, because they have a clear chain of command. So most recent example is block size increase. Has anyone heard of this debate going on right now? Okay, the TLDR is well, actually, I'll do you the TLDR. So people have known this for like 3-4 years, actually since the very beginning. In fact, there was a block size limit at 32 megabytes. I think Satoshi originally did. They brought it down to 1 later on. So if you'd written about this at all before 2 months ago, when Gavin started talking about it, you were called a concern troll. You were told to read the wiki, or that aggregate fees will increase because of reasons. I got those comments. People said, "Oh, Tim, you shouldn't talk about this. It's not a big deal. We'll have it solved. Don't worry." But there's economic and political trade-offs for having larger sizes. Okay, so again, I have no horse in the race. I don't own any equity in any of these companies pushing or whatever. So keeping a 1 meg block size, in theory, will require fees to be higher, and that becomes less inclusive. That's what they're saying is there's fewer people able to use it because the fees are higher. But you have less spam too, and the network's more decentralized. With the larger 20 meg block, basically fees to miners are supposed to be kept low, although it's subsidized off of the seniorage reward. But you also reduce privacy. Why does it reduce privacy? Anybody know? Why does having a 20 meg block reduce privacy? Okay, so in theory, if right now, actually in practice, we've seen the amount of nodes go from 13,000 from last March to about 6,000 today. I'm not saying there's a right amount of nodes. I don't know how many nodes there should be for good decentralization or whatever. But if blocks become larger and there's more of them, it takes more bandwidth to do. If you don't control your own node in your own home, and you just outsource it to Amazon or something like that, that's vulnerable to whatever attempts they want to do to fudge with stuff. So if you don't control your own node and you're reliant on other people, then it makes the network more easily identifiable in terms of transactions. The joke is, right now, about 10% of nodes are run by either government contractors or government agencies themselves to do money laundering assessments and stuff like that. So if you have larger blocks, the only people in the long run that are maybe able to run a node are these same agencies that you built censorship resistance around, or try and get around. So in the long run, you might actually, like Peter Todd's argument is, you might not have any privacy.
Well, plus you may be in a situation where the only kind of machine you can run it on is a virtual machine, which then is hosted someplace that's a known.
Yeah, and then that's vulnerable to whatever tampering they want to do to it. Any other questions about that? So I'm going to explain the 3 different groups and why this is an issue. So, by the way, these pictures come from Cointelegraph. It's about the only good thing they do is make really funny pictures. It's true. Most of the writing is horrible. So Gavin Andreessen and Mike Hearn are kind of one distinct group. Things happen around. Support behind them includes many Western VC-backed companies such as Coinbase. That's not to say that they're bad. I'm not singling them out because I think they're bad. It's just as an illustrative purposes. They've publicly claimed to both public and their own investors that Bitcoin can, defeat PayPal or compete with Visa or whatever. Like Mike Hearn himself was on Epicenter Bitcoin, a talk show about a month ago, and he's like, Bitcoin can overtake Visa in terms of transaction process. Just to get the same amount of transactions per second. The idea is Visa on their peak, the peak volume, they could do 50,000 transactions per second or more. It goes up every single year they test. To do that, to do these gigantic gigablocks, you would basically just have just a few nodes capable of doing it. You and I cannot finance that out of our house. We don't even have the capability. So you basically would have to outsource it to data centers, defeating kind of the whole decentralization purpose. So again, I'm not saying that that's going to happen. They were pushing for 20 meg. Now, I guess with BIP 101, it might just be 8.
How does that actually get rid of decentralization? That just means that you would have a bunch of rich players competing with one another, right?
But if they already know each other, right? You're not decentralized. If you know who these people are, all you have is just an oligopoly network of known players.
Those wouldn't, you can still have decentralization with known, it's just not.
But you have all the costs of decentralization without any of the benefits of it. Like, if you're spending $300 million maintaining this network, and there's only like 20 nodes, and they all know each other, why don't they just switch to permission? Like, you literally just add the structure of permission
You just
with the
whitelist
cost of
them
permission.
and then-
That seems like a logical leap, though, to say that you would only get to 20, right? Why would you?
Oh,
Like, why would you? Why
100, whatever,
I'm
but
just saying,
if
like,
you-
why would you assume that you would get to that state? Like, why would the competition not still maintain, even at scale?
How much does it cost to run, do a giga block every 10 minutes?
I don't know.
It's not cheap. But most people, like, for just to do a 20 meg, it's a terabyte a year of bandwidth. You know, most people have caps at 200 gig, 250 gig. So that's not including, streaming your Netflix and stuff like that. So for the average home user, they're not gonna be able to run their own node if you have gigantic blocks like this.
That doesn't make me think there's no decentralization just because it can't be each individual doing it.
But that's the whole.
You could have 100,000 large. I don't know. I think that's a little bit too binary, isn't it?
But I'm saying obviously it's not going to happen immediately. But if
Well,
you know you're
but other
trending
things
for that,
is, you're going to have to enter into a contract for that bandwidth. You're going to have to enter into that contract for whatever level of processing that you're having to do. You're going to have to get, SSL keys and private key infrastructure and BGP routing, hardening, and all those different things. If you're going to put that much money into hardening your system to prevent attacks, you're halfway to a trusted system that you could use permissioned anyhow. So.
and you wouldn't need the marginal cost of doing that.
But I remember 300 baud being smoking fast, putting the phone on. I mean, things advance. Prices come down.
Sure, I'm not arguing
I mean-
that Moore's law and Nielsen's law and all that stuff won't take place. I'm just saying we know for a fact that, at least in the U.S. and in many of these other developing countries, like you might just end up isolating yourselves. Like I'll get to why the Chinese are against it. Actually, let me skip that real quick. So the Chinese are against it because their net sucks. Like actually, our net sucks compared to theirs. Adam Back pointed this out to me on Twitter. I was like, look, a conspiracy theorist might say that the push for 20 meg is to kill China because they basically are reliant on a few nodes in a couple cities. And the way the Great Firewall works is basically you have these things called net splits where they can redirect traffic or block IPs altogether. Now, again, I worked out there for 5 years. I hated the least favorite thing was having to deal with horrible internet access to the rest of the world. So the Chinese community, over the last month or so, has come out strongly against bigger blocks because they don't have the network capacity to pump those through. Maybe that will change, but maybe not. So again, if you're designing a system that's supposed to be globally decentralized and you lose a country with 60% of your hash rate, you're kind of being very exclusive, or more exclusive than inclusive. But that's that side of the argument. By the way, this is a funny screen cap. This is Mike Hearn saying, Satoshi put Gavin in charge before he left. So there's a whole debate about who's in charge and who's not. And so Null C is Greg Maxwell. He says this is not correct. So we've had this debate about who's in charge and who's not. And again, I don't side with anyone. But again, if the whole purpose of being permissionless was to create a headless entity, and then you put a head on it, then I guess it kind of.
Can you summarize who each of those people are?
Okay, so Mike Hearn, he's been a developer for basically since late 2009, early 2010. He worked at Google, he left recently, he's on the board of Circle. He created something called Lighthouse, which is uses the Bitcoin blockchain to do assurance contracts, which is like Kickstarter. Greg Maxwell, he's been a dev, a Bitcoin core dev, they call it core devs, since about the same time, just a little bit less time, I guess, maybe by a few months. He now works at Blockstream, and they gave that presentation on some privacy features just a couple weeks ago, Elements. Anyone else? Bob Allison, I know his name, but he doesn't like people. He's actually writing a book on Bitcoin, it'll be out soon. Who else?
And Gavin.
So Gavin Andreessen was the former head of developing Bitcoin Core at Bitcoin Foundation, but he stepped down. Now he's at DCI, a digital currency initiative at MIT. He actually doesn't do a whole lot of coding himself anymore. I'm not saying that to be mean, just that's what he doesn't do. He goes around talking instead, which is, I guess if you want education.
We also wanted to talk about the whole what's going on with Bitcoin Foundation. That's also part of this.
So Bitcoin Foundation is bankrupt. TLDR. No, they burned through all but $600,000 of cash beginning of the year, and as a result, they don't have money for anything. So the developers left and went to MIT. And I guess the only thing that they're doing that's really productive right now is they run a website that does the nodes, right? The get address nodes or whatever. The BitNode, I think that's what it's called. Anyone been there? No? BitNode's a really useful site. Yes?
What does this have to do with permission?
I'm trying to explain why you don't want to use, like the case for why we are we've made Bitcoin into a permission system without any of the benefits of permission.
The benefits of a permissionless blockchain is that anyone can opt in, right? So
But
the fact that there's a power struggle for who's making decisions in Bitcoin right now has nothing to do, in my opinion, with like the benefits of a permissionless system.
Could you summarize?
So yeah, he was saying, why am I talking about governance struggle when permissionless systems allow you to opt in? This is in theory 2009. Yes, that's the case. But in practice, what we have is KYC on-ramps. Like going through Coinbase, you have to be KYC'd. I have a KYC'd account. My wife does too at Coinbase. And I'm not saying that's a bad thing, but if you're doing KYC, you don't need to use a permissionless system at this point, because you don't opt in. Anyone can't opt in. You have to have permission by your bank or by their compliance team or something. Same thing with being a validator on the network. Only certain people with certain capital can do that now. You can't run it on your computer. It's centralized to where you have to rely on about 12 pools. We could go into that issues, but my point with all this is the governance and how you are going to always have a governance problem with this, and why having clearer governance for permission systems is actually more desirable. So the debate that Gavin pointed out very rightly, and Mike pointed out very rightly, is in 18 months or so, we're going to have full blocks. And you can't build a financial system off of consistently full blocks because you can't get transactions in. TradeBlock did an analysis. They found it will have about 2.8 transactions per second by December or so next year. And so their thesis is, hey, you definitely need to increase that. So there's a stress test done about a week ago, and they discovered if you flood the network with just a bunch of small Satoshi amounts, 0.0001 BTC, you could actually make the network backlog by 3 or 4 hours. So if you're trying to build a financial product on this, you might as well just use a permission system, because there's no way you're going to be able to get the miners to include your stuff unless you pay huge fees. And if you're paying huge fees, why don't you just use a permission system? So here's the timeline of how things work. They actually broke blockchain.info in the process. They broke their Bitcoin D implementation. They're doing this stress test. That's not to say that any of those guys are bad. It wasn't designed to hit these numbers. You ended up with 14,000 transactions kind of backlogged. And so it took 4 or 5 hours to get through those. So if fees increase over time, doesn't reduce inclusivity of Bitcoin. So this chart, if you go to walletexplorer.com, they measure people who, the incoming and outgoing Bitcoin reuse address. They measure the reuse addresses for many different companies. So what they did is they looked at BitPay and Evolution Market. So BitPay, they do about 1,200 to 1,500 Bitcoins a day based on their current numbers. And Evolution Market, do you guys know what they were? They were a darknet market. Basically, they started in January last year. They actually overtook BitPay in terms of popularity, and then the founders had an exit scam. They took all the Bitcoins. And the reason that this is important is because the people actually complaining most about the higher fees are darknet market people, because they don't want to have to pay more for the illicit trade. Because in general, most people just don't, consumers like you and I, we just don't use BitPay. We don't use Bitcoin for actual payments, consumer payments right now. And so the argument that, oh, this is not inclusive by, if you don't increase the block size, it's no longer inclusive. Well, the truth of the matter is most of the stuff that is color-coded is spam. So what you could do, at the beginning of January 2012, and so this is actually just June, I had Oregon, his name's Andrew Gale, he's out in Australia. He put together this chart of long chains. Basically, most transaction volume on-chain on Bitcoin is basically like faucets, mining rewards, P2SH. It's transactions what we wouldn't call commerce, but it's actual movement of value. I'm not saying that there's no utility in it, but if there was higher fees, that activity probably would not take place. Instead, you'd probably have this linear growth right here. This is chains shorter than 10. I wrote a whole paper on that. You can talk about that later if you want. So my argument to you guys is let Bitcoin be Bitcoin and not Beano. So what we end up happening is, contrary to I guess people in Reddit, they're like, oh, Bitcoin is going to be the one true ledger for both permissioned and permissionless activity. But as I mentioned, number one, it doesn't have the capacity to do that. Number two, you don't have the governance to actually maintain that. And number three, it's just not safe because you could basically kill Bitcoin with just a few hundred transactions. Again, I'm not trying to be mean, but if you're looking for academic papers, here are 3. Heilman, the paper that was published earlier this year was on Eclipse attacks. how much it costs to actually flood and denial of service the network. Gervais, his paper just came out a couple weeks ago, and it's basically another block withholding attack. Andrew Miller, his paper was on, it's called CoinScope. He basically did a gigantic network analysis and found it's not very flat. It's very, very much like a power law. Basically, everyone uses APIs at certain companies like Toshi, Coinbase, and any of these other ones. That's not to say it's bad, but if you have a lot of value on there, it creates new attacks for like API providers and nodes and so forth. I don't want to bore you too much more. This is what Section 6 with the fees should have looked like. Satoshi assumed that fees would go up. They haven't. This is what TradeBlock found is in dollar-denominated terms, it's actually gone down over the last couple of years.
Which means specifically that the people are, the blockchain is being incentivized through speculation of the value of the blocks going up in value rather than the fact that transaction fees are going to be going up over time. Because again, the whole principle of that left chart is that at some point there is no blockchain rewards for, it's all transaction fees. And of course we've got all these people who are making bets on, oh, the transaction fees are going to be really low. And we've got people who are making bets of, oh, we're going to keep, there's going to be increased in price in block rewards. So it's not happening. It's not going to plan.
Maybe it changes. I'm just putting it for empirical data.
Maybe I'm confused here, but isn't what's happening right now where the miners are being incented on the future value of the blocks, doesn't that cover us for 130 years?
No.
Why not?
Because there's what ends up happening in practice is proof of work chains. Every proof of work chain that's ever gone through a block reward halving loses miners. Like we will lose miners in a block reward halving, like in terms of actual hash rate. So what ends up happening is you have basically self-destructive chains because they just have no incentive to actually keep on working. They just
What if the value of the?
But that's a bet on value. That's a forex play.
But that was the purpose of the.
He could be
scarcity.
wrong. He's not a financial. Do you know who Satoshi is?
Hopefully.
You probably did.
I mean, what?
I'm sure within this room, you probably know. No, my point is the guy. That's a whole different. That's a forex bet. That's not an actual tech bet.
I think that's my bet personally. Like
Well, but that's just your own personal view.
No, I know, but I'm saying that I think that the argument that was being made with the network is that this is going to work and that effectively you get to delay this issue for 130 years.
Okay, well they can make that assumption, but it's wrong. Like here's the actual data. Like I mean, maybe it changes, and then you can come back and say, Tim, you're wrong. That's totally fine. There's plenty of people who do that. My wife does it all the time.
I'm sorry, I don't understand why is it wrong now? I'm just confused. I'm not
so
arguing.
This is the chart it's supposed to do. This is the chart of actually what happens. So people aren't paying fees because they don't care about censorship resistance. They go to Coinbase and pay them fees instead. So like, I'm not trying to pick on Coinbase. You guys provide a real service. I'm not trying to be mean. So my point is people rather have faster transactions and get rid of and be okay with KYC and not actually use the purpose of blockchain. Like my favorite quote on Reddit, a funny quote on Reddit is, "Hey, how about you use blockchain next time instead of Coinbase?" No offense. So like, if you want, the reason why is because they had a transaction with Satoshi Dice blocked or something like that. So
I guess actually the real gap is what the value of like Bitcoin blockchain is, because like I would say that it's the immutability. Like the other blockchains are risky to me because of the potential for them to no longer exist, whereas this one doesn't have the potential to no longer exist, and that's actually the value to me.
You don't know
not
that.
The
You can't say that. Well,
no, I'm saying that the argument is that the system makes it less likely to fail than another system.
But when you say other system, you mean like Litecoin?
No, yeah, than like another blockchain. So like,
that's a proof of work blockchain.
Right, but this one with
But I'm
the
not
system.
talking about like proof. I'm talking about permission systems.
Okay, so maybe I am confused then.
Yeah, we're talking about two different things. That's okay. These are good questions. Though.
Okay, I'll ask you after.
Sure. Any other questions? So okay, completely disagree with me. Again, that's totally fine. So since we're having governance issues with increasing block size, now we've had a couple different people over the past week saying, hey, well, since we're already talking about this, let's make a hard cap a soft cap. So Brian Selkis, he's a stupid idiot. He's at Digital Currency Group. He's like, look, nobody's paying fees. Let's just increase permanent inflation. Adam Back wasn't a huge fan of that too. So the question then is when the time comes when the block reward halving happens next July or August, is this the same kind of discussion that's going to take place? And if so, who gets to make those decisions? Again, I have no horse in the race. I'm not saying one decision is great, but if you're having to go to a governance issue, then why don't you just use a permission chain? So the problem is Bitcoin has no native process for permanent forks. It actually it's not really future-proof. And that was by design. You know, Satoshi didn't have ability to do that. I don't think in 2008 when he was coding it, or 2007. Some use Bitcoin improvement proposals. It's a neat idea, but it's really just an ad hoc kludge. It's based on altruism and charity. And I'm not saying that to diminish all like the 100 BIPs out there. There's some really cool BIPs, BIP70s, payment protocols. It's neat. But so other networks have learned from this. PureNova, like I mentioned, they're down in San Jose. They have version control built into it permanently, so that way they could actually update the software if they need to. Tezos is a self-amending chain. Ethereum, they've explicitly said they're going to bomb the network in order to move from proof of work to proof of stake. And then a variety of other ones have clear governance. And I'm not saying that to say that this is, I'm endorsing them, but it's because they have clearer chains of command. At the same time, though, and I'll play the other side, there's different challenges these companies have now, especially KYC. I mean, Ripple got hit with an $800,000 fine from FinCEN for not doing SARs. So financial network, I would argue, is different than information network.
Can you explain proof of stake, please? Just
okay, just disclosure, there is not a single fully decentralized proof of stake system out there. All right, I'm not saying I'm endorsing it, but the idea is how can you maintain a network in a decentralized, pseudonymous manner without having to destroy capital in China, or destroy coal in China through proof of work. And the way that other people have proposed proof of stake is that you basically, if you have a 21 million units of whatever the currency, they've all been created out of thin air originally without having to do any work at it, it's allocated. Basically, those who actually have a certain amount of stake are those who actually get the validated. So the more stake you have, the better chances are that you actually mine the next transaction or block or whatever it might be. So it's a different way of trying to do validation, create consensus on a network that's public, that's pseudonymous, yet without having to do with proof of work. And again, I'm not endorsing it, I'm just saying there's a lot of work around it. Any other questions about that? Okay. Again, so right now Ethereum is also based on proof of work right now. They're not doing proof of stake yet. So Alan Goodman, creator of Tezos, again, he's the one who did self-amending chains so that way you could have clear governance. And his view, that a decentralized network does not internalize its governance to them designation or centralization. So I'm not saying he's necessarily right in the long run, but we've seen that with Bitcoin. That's why Blockstream created this whole system. Is because, hey, we realized that we can't fiddle around with Bitcoin Core without destroying a bunch of assets accidentally. So let's do a bunch of side chains. I'm not endorsing them. I actually think they have problems too. Assumptions on security. Again, this literally goes on to what you were just talking about. What is sustainable? We don't know. But we're doing some research. So there's a lot of people, especially big Bitcoin holders on social media saying, oh, it'll work, don't worry, don't worry. But if you actually do it, model it, what ends up happening is that you end up with a monopoly mining pool. I'll give you an example. So again, disclosure, I'm a visiting research fellow at SKBI in Singapore. One of the postgrads did this agent-based model. Basically what this shows is that over time, the blue line shows people in pools, people actually mining in pools. Black line shows people like us. Basically, you and I, we all have the capital to actually buy a miner, bring it home, but we just don't do it because the opportunity costs for us are just not worth it. So as you see, based on their modeling, more and more people opt out of the system even though they can do it. Red line is solo miners, those who don't belong to a pool. And what ends up happening in their model, at least, is you have basically a small oligopoly or monopoly pool that runs the whole network. I'm not saying that's great or bad, but we know it doesn't leave decentralization based on their parameters. So that was all the mean stuff about why you should use permission versus permissionless. I still think permissionless is cool. I just don't think it's being used in the right way. That's my own opinion. But about funding and investments. Venture Scanner, they found about $873 million in funding. This is a couple months ago. It's a little bit different though than CoinDesk numbers. CoinDesk has about $810 million, so I'm not sure exactly what the difference is. Their chart's a little wrong. PureNova is not in mining. They completely abandoned Bitcoin altogether. I'm not sure how many of these are bankrupt, and obviously there's some other companies that aren't mentioned here. Yeah, some of. We could talk about that all day. FinTech overall though, about $20 billion. About 1,200 companies. I'm not saying that all these companies in the Bitcoin space are fintech, but that's effectively what they're doing is building a financial system. Accenture just published this week, about $10 billion in fintech investments last year. They expect at least that much again this year. Where's the $800 million gone? Well, you have some companies that just apparently buy coins. Like BitPay apparently was on the record now saying, hey, we bought coins, oops. Some getaway cars. They were speculating on the appreciation of value, which didn't happen yet. Maybe it will. Getaway cars. So OB1 is a new company that develops OpenBazaar software. OpenBazaar is a decentralized merchant ecosystem. And the argument is, no, just because we're decentralized doesn't mean bad things are going to gravitate towards us. But in effect, if illicit activity does take place, you are in effect building a getaway card. Shapeshift is just a money laundering tool. You send in Litecoin, you convert it to Darkcoin, and you can't see provenance. Currency conversion, that's what mining is. Mining is taking one national unit of account, like dollars, euros, or RMB, converting it into Bitcoin. So it's just pure conversion play. The dozen areas, other cost centers. This is not necessarily unique to Bitcoin. I'm just posting it so you have an idea. I think the most expensive domain name I've heard in the Bitcoin space is, I won't name the company because you might know them. I was told that an API company spent $350,000 on their domain name, which is a significant amount of money for any company. Legal fees, some of these, like Perkins Coie, they have like 100 clients now, and they take equity positions, so that's not necessarily a big deal. Let's see here, event sponsorships, not big. Advisory fees, this is another thing. I was told that a number of the large hosted wallet companies pay fees to their banks, like SVB. They pay them like a monthly $60,000. American Banker did an article on that about 2 months ago, and it was related to Bitcoin companies and pot companies that have to pay banks in order to be banked. Acquiring board of directors, that's very well known. If you want to have cool directors, or you're going to have to pay them equity and some kind of funding. Money transmitter licenses, I believe Coinbase was saying that they pay $2 to $3 million a year in MSBs. I'm not sure, is that the latest number about that? Yeah. And I'm not saying that everyone needs to pay that, or if it's more. I don't know what the full number would be. Ransomware, actually I don't know any Bitcoin company that's been hit by ransomware itself. It's just, the FBI announced last week that over the last year about $18 million of ransomware took place using Bitcoin. So that's not necessarily a cost center for most Bitcoin companies unless you're doing the KYC on that. We're running low on time, so I'm not going to talk about the flows of funds and that kind of stuff. Instead, I'll say the conclusions. Basically, we have a lot of cool IP that's being built. BitPay have built a lot of cool IP, and now they're kind of quote-unquote pivoting, but not pivoting. So what I think will end up happening is, with just like PGP and OTR messaging and free open source software in general, is any of the utility that's created there, if it's open enough there, enterprises are going to fork it. And I also think that there's lots of room for both these systems to coexist. I know I might have sounded like being anti-Bitcoin. I'm not. I think Bitcoin's pretty cool. I think that turning it into a permission system, though, is really dumb. And so I think that a lot of the companies that you guys might go work for have a lot to teach fintech companies that I might be doing stuff with. And so I would just say the only thing that I have is this cautioning permissionless enthusiasts saying, hey, if you do all the on-ramps, KYC, and so forth, you're kind of defeating the main censorship resistant service purpose of it. So you end up with all the costs of both worlds without the benefits of either. So that's my presentation. Thanks, guys.
But let me ask you a question. So do you really think it's possible then? So permissionless, right? In a permissionless system, right? You're going to have all of these unknown actors, and discrimination is actually a function of the system, right? You almost need, the system sort of continues in and of itself until just a few people are speaking for the whole, right? And so those people then are saying, we're going to create these named, the on-ramps, everybody's going to know each other, and then you're going to turn this permissionless system into a permission system by default, right? So can you really ever have a permissionless system that ultimately doesn't end up growing up into a permission system in some way?
Sure. So, okay. Dave Hudson, I don't want to put words in his mouth, but he gave a presentation in August last year on how to, in his view, the core issue is block makers. The fact that there's an incentive to be a centralized block maker rather than a decentralized block maker. And block makers are just pools, people who make blocks, all right? And if you are familiar with how blocks are made, it's based on a Poisson process. It's on average 10 minutes that you create. So you create a bell curve, right in the middle is 10 minutes, and then the longest block I'm aware of took 99 minutes to actually be verified, or to be created, if you will. But then you have some blocks, like last week, F2 Pool found a block, one after one within a minute or so. So in his view, the biggest problem is the Poisson process, but that has to be built into Bitcoin. Otherwise, there's ways to game the system. And so in a way, it was, at least the way Bitcoin was set up, it's both a victim of its own success, and it doesn't seem like you could change Bitcoin as a permissionless system without having to fundamentally change how mining works. Again, if you're not familiar, as a solo miner, your odds of finding a Bitcoin with less than 1% of the hash rate is extremely low. Like the more hash rate you have, the higher your chances, up to a point. So this whole variance of payout, if you're a large, big time investor, for example, who invested in KNC? That was who were the European guys? It's Seth Pierpont and I'm sorry, I'm going blank here. So you have a number of different investors, like RE, who's invested in 21, or Pantera's invested in 21. So they all want to have a ROI, right? And the best way to get an ROI is to have more hash rate. So you have the kind of conflicting, desires. So on the one hand, you want to have a return on investment, but in order to do that, you end up becoming centralized. So until you
exactly, this is the fundamental issue, which is permissionless systems, by design, have a discrimination attribute at its core, which as those systems grow and mature, they become permissioned as a natural outcome. And so to say that we're going to have a permissionless system with all of these anonymous actors is not a state that can be maintained over time. It is a current state, but it is not a state that can be maintained. And so I think this whole discussion about permission versus permissionless is it just seems to me like everything will end up permissioned at some point in time. Whether it starts out as permissionless or the system is designed as permission from the get-go, it's just a natural outcome. Because that's the only way that you can actually make an economic argument.
Yeah.
Well, so I agree with you when it comes to things that connect to economic systems and fintech as we have it now. But there are also certain places where not having to exchange into the financial system to be able to do a lot of settlement without having to ultimately take it to dollars or something else like that can be a smoothing of things. But I think your point, Tim, is that if we're trying to do both in one, it's going to become.
You can't have censorship-resistant stuff in a permission system because you need to know the people. But if you, with permissionless systems, it was designed to be censorship-resistant. But if you start knowing who these people are, you might as well just use a permission.
Right. The economics don't.
Well, it's a marginal cost. Yeah, marginal cost doesn't make sense.
And there are places where, even excluding, the illegal uses, there are good uses for censorship-resistant mechanisms in certain markets. Auctions is actually one of those places. And we haven't even really seen auction systems on these types of places.
If you're going to optimize on that dimension, then absolutely.
It's also good because no protection, there's no personal data gets stolen. There's no big database, somebody knows all your names and addresses.
Sure. Then you can't build a credit system around that too. So, there's a trade-off, right? So, when people say, "Oh, we're going to build," Bitcoin can compete with Visa. Well, maybe with the debit side, but not on the credit side, because there's no credit facility within Bitcoin's network itself, right? There's no native ability to issue credit or have credit ratings.
You could put that layer on top, though. You could put that layer on top.
But then you asked some very good points. We can talk about that.
Can it be a spectrum? Is that possible? Could it be somewhere in between permissionless and permissioned? Is it binary?
I'm not going to say it is. I just haven't seen anyone make the case that you could have the marginal cost of a permissionless network with the features of permission and still transfer titles and stuff like that. Maybe there is. I just haven't seen someone actually lay it out.
Tim, as far as your argument about letting Bitcoin be Bitcoin and not trying to make it do too much and get top heavy, isn't there a tragedy and commons dynamic at play? Because in other words, let's say 95% of the people in the world hear your argument and say, that's right, we're not going to build anything on top. But now, Bitcoin exists. It's out there.
Sure.
And so,
there's nothing. Just because I say it, it's not going to happen. Because obviously, empirically, we see people don't care about that.
Right.
They'd rather build something on top of it.
Right.
Sure. It's my way to assuage the hardcore Bitcoiners, and I'm not anti-Bitcoin. So. Anyone else?
Completely different. What do you think about T0? and their approach. I mean, I don't know that much about, from a tech perspective, what they're doing, but
So he was asked, what do you think about T0? So T0 is the platform that Patrick Byrne is using for Overstock. They issued a crypto bond a couple weeks ago. I don't know any of the technical stuff. I know the team left the Medici project and founded Symbiont, Symbiont.io. It could just be another middleware. Like there's Vend, there's again Symbiont. There's when I say middleware, I mean they're using a blockchain somewhere, and they're just creating an interface that enables the issuance of something onto one of these blockchains. In this case, it's Bitcoin. I don't know the technical specs of T0s like things. They could be using open assets. They could be using Counterparty. I don't know.
they started with Counterparty, I think, and then they had a falling out or something.
Yeah, that's it. The Counterparty guys left
Yeah, yeah.
and founded the other one. So I don't know
Right.
what they're using today. I'm sorry.
Yeah. Okay.
Any other questions?
Round of applause for Tim Swanson. We'll take a 5-minute break.